This is Tony Moeller and Matt Ahrens with Integrity Advisory. We want to touch base on what's happened with the market recently. The market is as in the Dow Jones, the S&P, and the NASDAQ. The three major indexes are all down at least 10% from their highs, which is called a market correction, which we normally see occur every year. It's not an abnormal pattern.
Yeah, certainly this has caused a little bit of panic because over the last several months, 14 months, so well over a year, we really haven't seen this type of market activity. So it has caused a little bit of what we call panic selling in the stock market. We saw that this last Thursday, where we're having a little bit of a bounce off of bottoms, and then before you know it, by the end of the day, the market just fell off a cliff, and all three indexes were actually down over 4% on Thursday. So we're seeing quite a bit of volatility, but we are also seeing a lot of signs that we think are reason for optimism. So even though all three are down over 10%, a lot of technical indicators would say that we're oversold at this point. And up to date, all this has been caused by the coronavirus. So the coronavirus is impacting us in a lot of ways. Certainly travel's been impacted, so a lot of energy stocks and travel stocks have been negatively impacted substantially. A lot of conferences have been canceled. Tech companies have lowered their guidance for quarterly earnings and annual earnings for 2020. But really, what the real issue here is in the supply chain. So a lot of tech companies in America have their products either built or parts of their products built in China. And the Chinese people are basically shutting down a lot of these factories to help stem the spread of the coronavirus. So that almost single-handedly has caused major issues and major disruptions in the stock market, not just in the U.S., but around the world.
Let's take a look at a couple of charts. This first chart here compares intra-year declines to the final calendar year returns. So you've got kind of the line here through the middle. Everything on the downside that's in orange is the decline, all the way down to the intra-year bottom. So let's just take 2018 as an example. At what point during 2018 the S&P 500 was down 20%? So if you remember, that was in the fourth quarter of 2018. We got that's rounding. It was 19 and change, but in the fourth quarter of 2018. The final number for 2018 on December 31st was the S&P 500 down 6%. So that's the blue part of the bar. So you can see, going back to 1980, it's fairly common for us to have fairly large intra-year declines, but that doesn't necessarily mean that that something larger has started or that we're not in line for a rebound. But let's say what if we are in line for something larger? So this chart goes back to 1926, and since 1926, the average bull market has lasted 6.6 years with a cumulative return of 339%. The average bear market has lasted 1.3 years with an average cumulative loss of 38%. So oftentimes we say that bear markets are kind of fast and furious. They're very painful, but they typically don't last a long period of time. Bull markets tend to be more slow and plodding. So, as you're all well aware, this bull market that we've been in up until this point is the longest in U.S. history. So we certainly know the risk and the likelihood that it will come to an end at some point in time. But there's also a difference between a bear market and a recession. So a bear market is simply technical, saying that this index has dropped by 20% or more. We already have some individual securities in 2020 that are in bear market territory. So even if we have a drop of 20%, it doesn't necessarily mean that we're entering into a recession. It just means we have a lot of volatility currently in the stock market. So we just want to share these posts with you and these slides with you, just as a reminder that even if we are about to enter into something larger where we might experience a larger decline of 20% or more, it doesn't necessarily mean that the world is ending. There's going to be a time relatively soon we'll be able to start the rebound and work to come out of it.
I look at Warren Buffett, Leon Cooperman, and some of the large institutional investors. Not a one of them is selling. As a matter of fact, they're all talking about buying. They've either bought or they are preparing to buy. So this is an opportunity to buy things. Apple is a good example. Apple stock is down approximately 16% from its high. So that you're actually getting a coupon to buy it now. And that is going to then allow people to get into the market that were sitting on the sidelines with cash. So quite honestly, this is not much different than what we saw back in the fourth quarter of 2018, and especially in December. And Matt, I'll let you touch base on that briefly.
Yeah, so in the fourth quarter of 2018, we saw some pretty significant selling beginning of October. We had a little bit of a leveling out before December came around, and the S&P 500 was down about 12% for the month. So, not necessarily that we fully expect that this to happen, but it is a concern. So, at the moment, we fully expect there to be a bounce in the short term. All of the market indicators would suggest that we are oversold, and then we should have a bounce in the short term. That might be maybe short-lived, or it might be more lasting. A lot of that has to do with managing the coronavirus, and we see those in the headlines every single day. So if we have additional selling, like in the fourth quarter of 2018, then now is not the time to get out. I know we've had a lot of people, not a lot, we've had a few clients that have called and asked about, well, should we be raising cash? As Tony mentioned before, we're actually utilizing the cash that we have on the sidelines and picking up some stocks and picking up some securities that we like and that we think will have a strong rebound. But we will be watching it very closely, just because if we do see patterns develop similar to the fourth quarter of 2018, then after the bounce, there could be more to go after that. So we just want to be watchful, but we want to let you know that we are keeping an eye on these things, just to see that in the short term we expect a bounce, but we'll have to see how those things develop over the coming weeks and months.
But the one thing to leave on a note on is that history does repeat itself. And what I mean by that is, if you look at the SARS virus, Ebola, various different things, the markets were down. 6, 9 months, a year later, they were all up. Now, there's no guarantee of that, but if you look at history and you look at the odds are in our favor. That is what we see. That's what's been the trend. That is why we don't look at this as an opportunity to exit, but to stay put or actually get in, because there could be future profits ahead. If you have concerns, feel free to give us a call. We're happy to touch base on it. But this is not a time to make any dramatic moves, because we really believe fear is not an investment or trading strategy.